Hello everyone, good afternoon. Boa tarde a todos. It's a pleasure to stay here with you on the last WebSummit day. So we still have some questions to answer, and now we have with us Dom Mior and Juca Andrade and Tainá Reis to do this. As our topic is, are we heading for a global banking crisis? So this is the first question for us understand what you think about this. So let's start with you, Dom, with the question of this panel, please.
Sure. Thanks for having me. Today in the United States, the regional banking system is in free fall. Yesterday, the Fed announced a 25 basis point rate hike. And this morning, PacWest, the number 53 largest bank in the United States, share price dropped by 50% last I checked, down 90% year to date. How did we get here? SVB was the first domino to fall. SVB served a segment of the market that burns more cash than it takes in. It serves the technology ecosystem in Silicon Valley. With record level rate hikes, what we experienced was an asset liability mismatch that caused a ripple effect throughout the regional banking system. With FDIC coverage in the United States at $250,000, there were too much uninsured deposits on these banks' balance sheets. And as deposits left the banking system, crisis ensued. And so, how do we prevent this? There's both private market and public sector responses to prevent a global banking crisis. For one, the FDIC needs to increase its coverage from $250K to $1 million. That'll ensure 90% of commercial bank accounts in the United States across the 22.5 million commercial accounts in the US. Second, and why I don't think we're heading towards a global bank crisis, is the private market response. We'll get into 2008 later in this conversation, but we're seeing M&A by the too big to fail banks, acquiring the smaller regional banks that are struggling. And second, it's the role of technology. Technology, fintech specifically, is helping prevent this global systemic failure by stepping in to help these companies in a time of need and diversify cash across dozens or hundreds of banks across the regional banking system.
Juca, what do you think about and how your vision from Brazil too, yeah?
Okay, hi, good afternoon. Just to tell a little bit why I'm here, because I work for the stock exchange in Brazil. What does the stock exchange has to do with the banking crisis? We are also regulated by the Central Bank of Brazil, but in reality myself, I used to work for banks before joining the exchange. So I worked for big banks, US banks like Citibank, Bank of America in the past, and I joined the exchange 6 years ago. So to the answer to that question, so I have some experience on the market side, on the treasury or management of liquidity of the banks. So I have some experience in the past. I was present at the 2008 crisis. I was at Merrill Lynch at that moment, which turned to become Bank of America right after. So to answer your question, are we heading to a global banking crisis? My answer is no. It's hard to say no so emphatically as I'm saying, but probably not. And why is that? Because I think, as Don mentioned already, it's not a global banking crisis. It's a crisis for sure, but in the mid-sized banks in the US. So that's something different, and we can talk a little bit later about the 2008 crisis. But here, the issue is not the asset quality of the banks, but it's more on the liability side. So exactly as you mentioned, Don, the issue here is like a bank run on the mid-sized banks, and also so the liability of those banks and of those liabilities deposits not being insured by the FDIC. That's something that creates some kind of bank run. So people start to think that they might lose the money and start to withdraw the money. And that's a problem with any bank would suffer from a bank run, not only the mid-sized banks. If you have a big bank with a bank run, it will suffer as well. You have all the liquidity provisions, everything to cope with that situation. But in the case that everybody wants at the same time the money, the bank will not provide. So FDIC now is playing an important role, and they just said for the mid-sized banks that they're gonna be there and they're gonna guarantee all the deposits. So there are some issues going forward because of that, but at least so far they're doing that. They don't have an asset quality. It's like on the liability management side. So it's pretty different and it's located. So that's why my answer is no.
And Tainai, what is the vision?
I don't think the global banking system will collapse, but we will definitely be seeing who is swimming naked. The Credit Suisse was not a surprise due to the trouble that they had been on the past, but I do think that mid-sized banks in the US and who have the risk exposure to US Treasury bonds, they will see like a big trouble. And we need to get better at managing the risks exposure. We need to get more cash in hand if everybody wants to withdraw, we need liquidity immediately. So I do see will be a bumpy ride going forward, but not a collapse.
Let me comment a little bit on this part. When you look in terms of liquidity, the government bonds issued by the US Treasury are probably the most liquid asset in the world. So in that sense, liquidity is not an issue. But the problem with the case particular of Silicon Valley Bank is that they bought a lot of long-term bonds. And the long-term bonds already also have liquidity. But the problem is that they have zero deposits, zero rate, interest rate deposits, because interest rates were pretty low. And they bought 2% yield bonds. 30 years bond, 10-year bonds. And then what was the issue? When the Fed started to raise rates, that pretty much dropped the price of those bonds. And why is that? Because initially it was paying 2%. And for you, in order to make it to pay 4%, let's say, the price of those bonds needs to fall. And that was the problem. So the problem is that not the liquidity of the bond, but the price of the bond, which collapsed. And then they had to realize that or sold those bonds because people starting to withdraw the money. So they need to sell those bonds. And initially they didn't have the loss, but they really have to materialize that loss. And that's what provoked the issue with the bank in the end.
Something?
With yesterday's rate hike, 25 basis points, it was the 10th rate hike in just over a year in the United States. That's the fastest pace of rate hikes by the Federal Reserve in my lifetime, in most entrepreneur in Silicon Valley's lifetime, in Silicon Valley Bank, right, in 30 out of their 40 years of history. So they bought long-dated fixed income assets at 1.5%. Rates spiked, and all of a sudden there's this asset liability mismatch. That was problem one. Problem two is the nature of the businesses they served. These are cash-burning, hyper-growth tech companies that rely on venture capital funding. Venture capital funding stopped. So there's no more inflows, coupled with cash burning by the portfolio companies of these banks. That's outflows. So deposits were declining at SVB and FRB and now PacWest. And as a result, declining deposits, asset liability mismatch resulted in systemic failure. So is the Fed to blame? Are the VCs to blame? Are the startups to blame? Who knows? There's plenty of fingers to be pointed around. What I'll say is it's really on the Fed to step in and increase FDIC coverage to prevent future issues like this from occurring, and ultimately to preserve the value of the regional banking system.
But just to complete on that as well, it's important to mention that for the last 10 years or more, maybe since the 2008 crisis, rates have been pretty low. And as you said, like a lot of companies appeared from there, like we're talking about 15 years. And for the last 15 years, interest rates has been really low since the crisis, right? So for you, for example, you never saw interest rates so high, but that's something that was present before the crisis. And that's part of the issue that the newcomers are not totally familiar with that type of thing. So zero interest rates probably not there anymore, I believe, because that was some kind of an issue that created those types of problems.
Okay, then I want to ask you about the new economies and how we can make a difference, because you talk more about this, you can talk more about this, so I want to listen to you a little bit about they're talking and what do you think about this?
That is a big question into capitalism. What real value we are bringing, what the banks that we choose to hold our money are bringing value to the society. So in the crypto space, we have this concept called regenerative finance, where we do need today to include financial incentives for impact and social environmental space too. So we need to consider those topics today, not money for money, but money for what value we are creating to the society. That's what we need for the future.
What do you think about this, Don?
2008 financial crisis there were really two levers you could pull to prevent global systemic failure. There was M&A by larger banks, and there was intervention by the federal government. Those same two levers exist today. So what's different? The difference is the role of technology. And as I said in my prior response, I think technology is the savior of the banking ecosystem. It's the prevalence of banking as a service infrastructure and digital banks that can step in and provide a level of diversification that a traditional bank could only dream of. That level of diversification can help spread risk across the broader banking ecosystem and eliminate these issues going forward.
How to say, Juca, you was working in a bank in 2008. What's the biggest difference for you about that time, that crisis in the United States, and the crisis, the last crisis, yeah?
Yeah, I think Don mentioned a little bit, but in that moment, the thing was different because first, currently the problem was the liability side, the deposits of that banks. At that moment, in 2008, the problem were with the quality of the assets. So that's a different story because then liquidity might be really a concern and the credit risk on the bank was much higher. So first of this, there was a big concentration of the assets of the banks in the real estate sector, especially on the retail, let's say, real estate. So the problem is that there are too much leverage, a lot of people buying homes and buying the second home, the third home, and then a lot of leverage, people borrowing money to buy those houses. And the banks were saying, no, we're diversified. How we were diversified? We're not lending only to real estate in New York. We're also lending to real estate in California, maybe in Texas. But the problem was that diversification didn't work because everything collapsed at once. So the diversification didn't happen at the end. So a lot of trouble with all the assets of the banks and also big banks. We're not talking about small banks. At that moment, we have the brokerage, like starting with Bear Stearns, then Lehman Brothers, then Merrill Lynch, then Morgan Stanley, then Goldman Sachs. All of those were brokers. They were not banks, but they acting at that moment like banks. That's why they turned into banks. They were acquired by banks, some kinds. In the case of Merrill Lynch, for example, some went under, which was Lehman Brothers. So it's a big different story because of the size of the banks and the concentration of the quality of the assets.
So let's talk. You can
The
talk.
authorities are much ready to handle challenges today than they were in 2018. But today we have seen like a big changing in world order with China rising in like many commodities, apart resources. So we do definitely need to see the perspectives in a global perspective, what China is bringing to the table too, and many contracts that are running away from dollar. So the dollar risk exposure and like many contracts being held on euros, and now people are seeing like, is dollar really a good reserve to have, and as a, what are the liabilities for that too? So I do see that.
So let's talk more about the future. What do you think about the future for the next 3-5 years? Donald, you can start and talk how your perspectives too.
The number one question I've received at WebSummit is, where is all the cash gone? SVB out of business, FRB shuttered, now PacWest down 90%, likely to be acquired. Where did all these deposits go? We cut the data at ARC and we found that nearly 100% of the deposits went to JP Morgan Chase, Wells Fargo, and the BAM fintechs, Brex, ARC, Mercury Bank in the United States. It's my view that the future of banking, the next generation bank for Silicon Valley, will not be a bank at all. Brex, ARC, Mercury, we're not banks. And customers, depositors, tech startups, they now realize that's actually a good thing. As I was saying, at ARC, we can achieve a level of deposit diversification that traditional banks simply can't accomplish, because ARC is a technology layer that sits on top of a network of the most systemically important financial institutions in the world that are too big to fail. We can effectively diversify deposits to achieve 20 plus FDIC coverage at the click of a button. And at the same time, we can provide the type of customized support that a software founder that's growing at 300% year over year expects and deserves.
For you, Tena, the future.
Yes, there is a lot of people that are underserved, billions of people that we need to include in the economy, and the banks should be designed to be inclusive today. So I do see with the rise of cryptocurrencies and decentralization, like more opportunities for people to be included on the economy.
Juka?
Yeah, it's important. Don't mention the situation that we're facing right now. It's a run to quality, which is, I think, it's not good for the system because you're increasing concentration. And I think that's something that's happening right now, but I don't believe that's going to happen going forward. I think that's going to be the opposite. I think the more that we have technology, as you're saying, and new solutions provided through technology and all the sources that technology can provide, it's important as another type of diversification for customers. So if you look at Brazil, for example, and I can talk about Brazil right now, we have the big banks, which are, the system in Brazil is very solid, but it's important to mention that there is a new bank in Brazil that they were here in the first panel, that it's Nubank. Nubank is a total digital bank and also have 80 million customers, and they have not even a single branch. It's everything electronically. So, and that brings technology, that brings the banking service to the people. So I think that's something that's really important to notice. I think the banks also, the incumbents, are moving into that direction. But I think that will bring a lot of bancarization and services to the people, and I agree with that.
You make a really good point. These regional banks, these sector-specific banks, they serve a really valuable role in individual communities. In Silicon Valley specifically, the crisis we're experiencing in the United States today, it's very specific to the tech economy. And SVB, FRB, they were darlings in the space. Many of the largest, most durable brands that we all use in our daily lives, they were built on the backs of SVB. They understand their customer base. They provide them with very customized loan, working capital solutions, level of customer service that a big four behemoth bank simply can't serve. Those large banks are too busy serving their multi-billion-dollar publicly traded corporate clients that are profitable with positive free cash flow to actually serve this earlier segment, very unique, hyper-growth segment of the economy. And so the value of the regional banking system can't be understated. And if the Fed wants to preserve that system, they should think very critically about increasing FDIC coverage and partnering with fintechs to keep those bank systems alive.
And we definitely need education to be a big play role into that too. So at Inclusiva, that's what we do. We take vulnerabilities into the education side and bring that forward. That's what I do think. With financial literacy, more people can be included on the economy too.
Okay, thank you for today, for sharing with us our ideas. Thanks so much, everyone, and that's it.